February is an important month for the markets. Sure, sales of lingerie, jewelry, maybe some 50 Shades of Grey gear.
My tastes are very singular.
And chocolate spike during the month. And Valentine's is a key holiday for dating apps like Bumble and Match, as well as special occasion restaurants like Roost Hospitality.
Check, please.
But what I'm talking about today is something much larger. I'm Matthew Carr, Chief Trend Strategist at the Oxford Club. Thank you for watching this episode of Market Trends. And if you're new here, be sure to hit that subscribe button and turn on notifications so you never miss out on my best trading ideas, which I share here each and every week. Now, each month on Profit Trends, I like to break down what investors should expect for the month ahead. For instance, I wrote that investors should be prepared for a market sell-off in January, and that's exactly what we got.
I told you so.
January is historically one of the worst months for stocks. Forget what you might hear elsewhere. The truth is, it is a terrible month.
You're horrible!
But now I'm warning that investors really need to keep an eye on February because this is where precedents for the year are set.
There's no going back now.
Since 1993, the Dow Jones Industrial Average has averaged a modest gain in February. And that puts February among the good months for stocks, though dead last among these. February is technically the 8th best month of the year for investors. The only months which are worse for the markets are January, June, August, and September. But it's important to note that the volatility and panic that typically rattles investors in January doesn't often carry over into the shortest month of the year, February. In fact, since 1993, almost 30 years, the markets have continued January sell-off into February only 5 times. That was in 2000, 2003, 2008, 2009, and 2020. And if you've been investing long enough, then you know each of those were all hands on deck moments. In 2000, 2008, and 2020, the broader markets, simply imploded. Bear markets were born as sell-offs in January gained speed in February. This set alarm bells going off everywhere. In 2003 and 2009, the continuation of the pullbacks that began in January marked we were at or near market bottoms, which were eventually hit, in early to late March, right? These signaled, great buying opportunities as the sell-offs simply exhausted themselves. So I always say market drops in January can largely be ignored. January is, like I said, historically one of the worst months for stocks. And that's because what happens is we just exited the best 3-month stretch of the year, October, November, and December. And then we get into an air pocket between the end of the holiday shopping season in December, which is extremely important, and the heart of fourth quarter earnings seasons, which begins in early and mid-February. So to me, February has always been the month to watch.
Don't drop that!
Forget, the January barometer. It should be the February forecast. The Dow has ended February with a loss 10 times since 1993. That means blue chips gain 65.5% of the time in the month. That's better than average. And for the most part, February is a great month for stocks. All the jitteriness over earnings that we typically see begin to rear up in January are erased, and there's this bounce higher. But here's the deal. When the Dow does decline in February, the move tends to be significant. I'm talking an average drop of 4.9%. And since the majority of fourth quarter earnings are reported in February, the market struggling in the month is a very good indicator that there's something to be concerned about at the corporate level.
I don't like the sound of that.
We can clearly see from the chart that the market drops in February are largely clumped together, right? They occurring in 1999, 2000, 2001, and 2003, and then again in 2007, 2008, and 2009. We also had drops in 2018 and 2020. Now, no surprise, much of those drops occurred over the largest market declines in history. More importantly, the initial drops in February in 1999 and 2007 preceded the bear markets that would take place by months, right? These were the first concrete red flags of the systemic collapses to come.
Red flag.
Even in 2018, that big drop in the Dow during the month of February was an early warning of the carnage that would unfold, months later, especially in December, as the U.S.-China trade war really came to a head that year.
Red flag.
And of course, the 2020 drop in February was all part of the one of the largest market declines ever, and beginning of the very short COVID bear market.
That's a major red flag.
So investors should expect the markets to rebound from January's annual sell-off in February, right? That's the good news. But be warned, if the markets do struggle in February, which only happens 34% of the time, investors must sit up and take notice, because that means there is something very real to be concerned about.
Hey Albert, is that a raincoat?
Well, I'm Matthew Carr, Chief Trend Strategist at the Oxford Club. Thank you for watching this episode of Market Trends. For more information like this, be sure to go down to the description and sign up for my free e-letter. Until next time, here's to high returns.